Welcome to the penultimate webcast of mine for the year 2024. It's hard to believe that we're already barreling into year end. We do have another webcast that I'm not doing that's on our diversified fixed income funds. They'll be in October. You can see on the screen the image of Big Brother watching, and the title of this webcast is 1984. And I entitled it that a couple of months ago. And it came to me that I had not read 1984 in a long time. And so I started to reread it. And if you've never read 1984, it's harrowing, but you could try take a spin at it. On my reread, I got to about chapter 4 and I had to stop because I couldn't take it anymore. It was just too very similar to the world in which we're living today. What I'm going to talk about today is a little bit more narrow and a deeper dive into the subject of the Fed and some of the variables that will likely underpin their logic and their thinking for the meeting next week. It's interesting that since the Fed, in the last several Fed meetings, since the July meeting, the number one performing sort of standardized asset class is long-term Treasuries, up 6.3%. Nothing else is up anywhere close. That the S&P gold is second best, I guess, at 4%. Since the June 12th Fed day, the long bond ETF is also the number one performing standardized asset class, and since the May meeting. So the long-term Treasuries have been a top performer now for going on 4 months. And interestingly, going back to all the Fed meetings over the past year, all of the rates on the yield curve, 2 years and on out to 30 years, are now down since the September 2023 meeting and every meeting since in through the July meeting. So here has been the volatility of the markets thinking about what the Fed might be doing in the future. So you can see that January 12th, 2024 is the red line, and there was a very aggressive Fed cutting cycle that was priced into the bond market as we entered 2024. Then you can see near the upper right, we see the June plot where they pivoted, and we also see April on there, and you'll notice that they were very different from where they were at year end, and they didn't change much between those time periods. And then all of a sudden, we had the Powell pivot at the last meeting, in which I said on CNBC, much to Scott Wapner's surprise, that I expected fairly quickly 150 basis points of Fed funds cuts within no longer than a year, and probably significantly less than a year. And now look at the black line, which is the current forecast using the shape of the bond market's yield curve. And we can see that it's actually even more aggressive on a 1 year forward basis than where we were entering with a dovish market sentiment and entering 2024. So the red line showed from January 2024 through in the end of 2024, there would be about 180 basis points of rate cuts from 5.3 to about 3.7 or so. And now the black line, we can compare it 1 year forward, look out at September 2025, and the forecast is about 2.9%. And right now it's 5.0%. So it's actually 210 basis points. So it's 8 full rate cuts in the next upcoming 12 months. And this has been changing pretty rapidly. So the Fed has been very tight. Jay Powell said that in plain English at the July press conference, and we can see what he means by that in one chart. And this is the Fed funds rate minus the U.S. headline CPI. And we can see that it's the highest that it's been in basically almost 20 years, since prior to the global financial crisis. And it's been negative for most of this time period. The Fed funds rate was negative for over 10 years with small interruptions, and now we can see it's all the way up at 2.43. So the Fed is going to be easing almost certainly at the meeting next week, and we'll talk about why. I've always said that the Fed funds rate just follows the 2 year Treasury. The Fed just follows, and we'll notice that it actually sort of leads, the gray line leads the blue line most of the time, particularly in more recent cycles. It's led the blue line, the Fed funds target rate. And now we say that we're actually further ahead. In other words, the Fed is further behind, with their upper end of their range being 550, while the 2 year Treasury is now down to about 3.6. As of yesterday, I guess it was a little bit higher. But now there's this huge gap between the Fed funds rate and where the 2-year Treasury is guiding. And so no wonder the market is talking about the potential for a 50 basis point cut at the meeting next week. I don't have the chart on here, but you can also do the same thing for the Fed funds rate versus the 10-year U.S. Treasury. And that's even more out of whack by historical standards. Over the last couple of decades, there has never been a Fed cycle where the 10-year Treasury was leading the Fed funds rate so heavily. In fact, the 10-year Treasury is about 3.65. So we're talking about 175 basis points or so below the Fed funds rate. So this is unusual. I expect that unlike past initial cutting cycles, the 10-year Treasury probably won't rally as much this time because it's already discounted it in. We haven't seen anywhere near this gap prior to the Fed's first rate cut of the Fed funds rate versus the 10-year Treasury. So let's talk about what is driving the Fed's decision. They always talk about the dual mandate, and that is inflation and full employment or a strong employment economy. So first, let's talk about inflation. We're going to go into a lot of things here, and there's some strong takeaways. Here's the CPI, the headline, which is at 2.9%, and the so-called core, which excludes food and energy, which is at 3.2%. It's pretty obvious that these are in a declining mode. But we now are looking at a very substantial drop in the headline CPI in the next 6 months or so, based on the rapid decline in the price of oil that has occurred over the past couple of months. It's actually down about 25% over about a 3-month period. We now predict that the inflation rate, the headline CPI, within a few months is going to have a 1 handle on it. It'll be below 2% if oil stays in the mid-60s. The CPI is going down fast. I wonder if that won't prompt the Fed to start talking about that they are undershooting on their inflation target, because if the commodity structure stays where it is now, it's going to stay below 2 for months at a time going into next year. And that doesn't even fully factor in a normalization in the shelter component, which we expect will happen. And I'll talk about that in a couple of slides. So here is annualizing the shorter term periods. And this became popular about a year ago when the Fed was looking for excuses to discount what was stickier inflation than they wanted. They started looking not just at year over year, but at 3-month annualized, 6-month annualized, and so on. And now we can see that the 3-month annualized headline CPI is below 0.5%, because we had 3 months of low prints. The core CPI is well below 2% if we annualize the 3 months. That's a very significant change from where we were in the prior quarters, because you can see if we annualize the 6-month numbers, it's actually 2.5 on the headline CPI, just slightly below the 12-month headline number, and the core number is up at 2.8. So the recent inflation data has been very different, and I expect that that will stay subdued based upon the commodity complex, which we'll take a look at in a few slides forward. Where's the inflation coming from? Well, here's a stacked bar, and you can see that the black line at 2.9 is right on top of the blue bar. So core services is the only area of the CPI that has any inflation at all to speak of. Everything else neutralizes out at 0. So if core services comes down, then assuredly the inflation rate will go below 2%. Here's the contributions to core inflation. Here we see that it's not just shelter, but it is the core services, basically ex-shelter is adding some amount as well. So there is 2 components here that are rising, unlike only the one really on a net basis for the headline CPI. But here's shelter inflation, and it's been coming down. It's been coming down. The core CPI ex-shelter inflation, that is, has been coming down. So if we take out shelter, which is the only thing that's adding to the headline CPI number, if we take shelter out of core, so we're slicing and dicing pretty finely here, but actually shelter without shelter in the core CPI, I understand that this represents less than probably half of what people spend their money on, but it is below 2%. And I'm sure the Fed is aware of this as well. More evidence that you could support the logic for a 50 basis point rate cut next week. But here's the kicker, and that is that the CPI shelter inflation, that's the dark line, it's up at 5.05%, whereas the new tenant rent index is actually negative 1.1. So there's a huge catch-up that is likely to happen from the urban consumers' housing and shelter component, because it over time, and this goes back 20 years, over time, not surprisingly, they end up in about the same place much of the time. When there's volatility, it looks like the CPI component tends to lag, and you get a lead effect from the tenant rolls. And so one would expect the shelter would moderate pretty radically. Again, good logic for a 50 basis point cut, given the huge gap between the 2-year Treasury and the 5 3/8 average middle of the Fed funds target range by the Fed. So here's another measure. This is one I think the Fed cares even more about. This is PCE, Personal Consumption Expenditure Index, and we see that it's also relaxed. It's actually lower, typically is lower than the CPI, but headline and core are virtually identical at 2.6 for the core, 1/10 higher than the headline rate at 2.5. But these both also have downward momentum and would likely also have the same type of behavior as the CPI as we factor in the lags on the shelter component. Here we are annualizing those shorter-term periods like we did in the prior CPI section. Here, they're not as low for the last 3 months, but they're still well below the Fed's 2% target. The headline is at 0.9, and the core is at 1.7. Here, the 6-month numbers are similar to the CPI. We have 2.3 on the headline and 2.6. So we're getting quite close to the PCE. I think this is what has Jay Powell saying he's got increased confidence that we're heading to the right place at the 2% target rate, although here the headline number seems to have stalled out. But with the falling commodity prices, we would expect that this would also head down towards the 2% level. There's seasonality in the core PCE, which I talked about a year ago, but here it is again. You tend to get a bump up on a seasonal basis, even though these numbers are supposedly seasonally adjusted. The fact is that they don't seem to be adjusting them all the way that they should be, because you can see that the first quarter is the highest inflation on a median. The second quarter is elevated as well, and then you have third and fourth quarter, which tend to be actually negative. So we would have a reason to believe that we're not going to be surprised to the upside because of seasonal effects on these inflation numbers that are coming out here in the fourth quarter of 2024. Super core inflation, this you never hear about. This is if you want to be an inflationist and you want to have ammunition to support the idea that inflation might reaccelerate or might not come down as the Fed is hoping for and that I'm predicting, you can say, well, look at the super core, which was rolled out a couple of years ago because they were hoping to ignore the high volatility on the headline CPI, so they started stripping out more things. So this is now core CPI less housing, which is at 4.48 on the CPI, and on the PCE, it's at 3.25. Yes, the PCE number is coming down, but it would be hard to characterize the dark line as really systematically declining on a trend basis since it's been going sideways for a year. So we'll see what happens and if anybody cares about supercore CPI anymore. Let's go to the more high-frequency inflation data. Here's producer price indices, which lead the CPI and the PCE because these are wholesale prices and not seller prices. So it's in front of the actual production. And so we see that the PPI final demand got very low. It got down almost to zero, but it's up at 2.25. And we see that the gray line, which is 3.3. That's PPI final demand sort of core number. So these are still a little more elevated, but these probably were reacting to some of the strength in commodity prices a few months ago, and that is completely reversed. And so we would expect to see the PPI coming down as well. So there's a lot of logic for cutting rates if you're looking at the inflation side of the mandate. Everybody knows that I like the best export and import prices. These have been volatile for sure, as they always are, but lately they've been running below 2% at 1.7 for import prices and 1.4 for export prices. Nothing here to cause any concern about the 2% target somehow being reversed from the bottom to the upside. Here's the gasoline prices versus WTI prices. And this goes through yesterday. So WTI is at 66 right now. It's down over $2 on the day. And here it was a little below 69 yesterday. And not surprisingly, gasoline prices follow WTI prices. And so there you have it. We see that there's good logic to believe gasoline prices could be coming down. So not a lot of inflation coming from the very important energy sector. And here's commodities broadly, the Bloomberg Commodity Index, which had some strength there back in April, May, and June, but it was another false start for the commodity market. And we're right back below the 200-day moving average. And in fact, as of today, this was yesterday's print, we're down again today, we're at the low of the year. In fact, we're at the low for almost 2 years on commodity prices. So here we are without any inflationary signals. And that's even though the dollar has been relatively weak versus, say, the euro, it had come down some. So it's not percolating through into the commodity market, which is suggestive of weak global demand. So weaker global economy. And we all know that the Shanghai stock market has been very weak and lots of problems in the Chinese economy, it appears. Now, here is an interesting chart. I put this on just for informative purposes because I think it's sort of interesting. We calculate CPI one way, and the Eurozone calculates inflation another way, their consumer prices. And our consumer price methodology differs from Europe's. We have more of an emphasis on housing in our consumer price calculations. The interesting thing here is Europe's CPI, the way they calculate it, is at 2.8. We saw that ours was up at around 3 or so. But if we calculated our CPI using the European methodology, we would calculate it to be 1.72, fully 108 basis points lower than European CPI using the same calculation methodology as they do. And it's fascinating that we have been reluctant to cut rates, whereas Europe has cut rates. And so we are kind of in a strange spot where we would appear to have higher inflation, and yet we haven't cut yet. Further motivation for cutting rates. I said they should have cut them last July, and I believed that then, and I believe it now. I think most people see that now, since we have this massive gap between market pricing and the Fed, which has been slow to react, being led by the market per usual. Now, here's the problem. Here's the problem in the economy and what the politicians don't seem to understand. This is the CPI level. This is not year over year. The index has a level to it. And you can see that both the all items blue line and the less food and energy line were going up kind of in sync with each other. And this goes back to, well, 1984. We're going to do a lot of charts being in 1984, which is one of the reasons this webcast is entitled 1984. We can see that, there's some variation, but all of a sudden you get to 2020 and you have this complete change of trajectory on the CPI, and it goes up by a lot, by 25% or so, or since 2020. And this is what consumers are feeling and why they're not happy. You can tell them all about how it's great that inflation is approaching 2%, but the price level is still up 25% from where it was 4 years ago. And that is a problem because people are suffering and they can't afford it. And there's many, many articles and stories about families where the parents are eating every other day because they only can get, with them skipping days, they only have to have their kids skip one meal a day. And this is what the problem is. It's the level of inflation. And it will take a long time for this to get back to sort of the longer term trend line. We would have to have sideways prices for quite a while. Another thing that got elevated right after the lockdown, was the M2 money supply with all that money printing. And this has the same look, and I say not surprisingly, same look as the CPI. Here we have the same deal. The money supply was exploded higher. It led to all that inflation. Now it's been going sideways for a couple of years. So it's quite sensible that inflation should be low for a protracted period because we don't have the money supply being gunned. And yet still, we don't have deflation because there's all this M2 above the long-term trend line that's been sloshing around in the system. And this is one of the reasons that I've been talking about why many of the traditional recession indicators have been either inaccurate and not helpful or lagged in the way that they've been helpful. And we're going to get to that in the next section. Another big problem is auto insurance inflation. Just imagine what the cumulative inflation is on auto insurance when you have a 19% increase for motor vehicle insurance year over year. And we can see that it's still rising pretty significantly on a month-over-month basis. So auto insurance looks like it's up over the last 2 years, something close to 40%. And that, of course, is something that you are required by law to have if you're going to legally operate a motor vehicle in the United States, or at least the states that I've lived in. I can't speak to every state. Now, here is the long-term trend line of CPI. And this has the same look to it, but we see that the 10-year CPI has been on the core level 3% annualized, and the PCE has been 2.5 annualized. The 20-year number on the PCE is right on top of the Fed's target of 2%. It's 2.1% for the 20 years. And we look at the core CPI, and it's at 2.4%. It's elevated because these dotted lines are 2% trend lines. We've been rising from 2006 until 2022 at about that 2% level on an average basis. And now we're way up at this spike. And so again, we would need this to go sideways for quite a while for us to catch up to that red line. It looks to me like it might take 4 or 5 years. So here we are with U.S. home prices versus disposable income per capita. And here's another one for the inflationists, because we see that home prices have gone straight up and they're not stopping. It looked like they maybe were taking a break there a year ago, but we see that the Case-Shiller National Home Price Index is at a new high, and it's risen in a lot of places, surprisingly, like Los Angeles and Manhattan, not surprisingly, but Los Angeles, I think, surprisingly, by about 8% over the past 12 months. And you can sort of see those are substantial areas that drive these numbers. And we can see that we are been way off to the races, really, since the end of the global financial crisis, but on steroids since 2020. Now, the problem that the consumers are feeling is disposable income is now way out of whack on a trend basis versus home prices. Frankly, it looks like, God forbid, 2006 type of affordability, where disposable income is completely lagging the Shiller Home Price Index. And this is why we have such a sluggish housing market, no doubt, and also higher interest rates. We're stopping that. We'll see what happens now that mortgage rates are down 100 basis points from their highs and perhaps can go lower. It's our opinion at DoubleLine that if we get to a sub-6 mortgage rate, it might start to unlock some of that ossified supply, because buyers didn't want to switch to such a high rate mortgage. If we can get down into the 5s on the 30-year amortizing mortgage, that might unlock supply, which might take home prices down. So it's not clear to me. This has a feel of inflation, but also has potentially to portend some stabilization or even declines in some areas of the home market. I know that some of the areas that were emigrated to, like Austin, Texas, and Miami, and parts of Florida, I know that some of those areas are actually having deflation in the home market because of the tremendous overinvestment during the lockdown. And now, if you're an inflationist, I got one more chart for you. Global shipping rates with a 6-month lag. Global container rates are the blue line, and they lead. This is a 6-month lead on the blue line versus the black line, U.S. PPI final goods. And that has bottomed out, as we saw on the chart. And there is a good correlation here. So maybe it's possible. I don't really predict that it's going to happen, but it's possible that if you're an inflationist, you've got something to lean on here. Almost all of this inflation section supports the Fed's increased confidence that they've been making the appropriate progress on the inflation rate. Now, this is a 1974 Matador. And I'm going to talk about, are we in a recession or not? And I'm going to talk about, are we really being shown accurate data? The Matador some people have a great fondness for this car, 1974 AMC Matador. There are some people that think this is the most beautiful car ever made. I am not in that camp. I am actually in the camp, this is one of the ugliest cars ever made, and really symbolic of the sort of malaise era on the 70s into the middle 80s. late 70s into about 1980. And what's funny about Matador, I remember this when I was a kid, they advertised the 1974 Matador in the first commercial by showing it with a sheet over it. The car, in my opinion, was so ugly that the Madison Avenue advisors for the commercial said, this car is so ugly, we've got to try something gimmicky. And they actually put a cape over it. I'm of the opinion that's why they called it a Matador. They go, oh my gosh, this turned out so bad, we got to cover it up. And like a Matador's cape had the sheet over it. And then this neighbor comes over to the guy who's got the sheet over his car. And he says, what's this? You got a new car? And he rips the sheet off and he says, it's a Matador. And I thought that was really funny because it's sort of like they were reluctant to show you the car and they were more comfortable covering it up. And then, shocker, here's this car that they're advertising. So let's talk about some things in the economy and are we covering stuff up? Well, first of all, let's one more thing on the Fed. This is a recession indicator for sure. The U.S. yield curve is steepening before the recession. The twos, tens got to a negative 108 basis points at its maximum inversion, and now it's positive 6. And you can see in past recessions going back to 1980 or 1984 for that matter, you can see that the curve de-inverts before the shaded areas every time. So we did not give a false signal on recession by the yield curve being inverted. The recession signal was only given this week with the twos 10 spread going positive. I'll acknowledge that the spread is not very positive, so we'll see if this endures, but you'll notice historically that when it de-inverts, it tends to de-invert very much further from the zero line, hundreds of basis points. And I believe that will happen again, but perhaps not initially to the same extent that it has typically historically, because the 10-year has already rallied so much. I think the surprise here that this took so long to de-invert is that the 10-year rate was falling pretty much in sync with the 2-year for a while, but now the 2-year rate has been falling faster. Here's the old consumer confidence versus for expectations versus the present situation. And you'll notice that the tannish line has been deteriorating on a trend basis. It had been holding up and going sideways while the view of the future, the dark line, had been deteriorating, but now the view of the future has stabilized and the view of the present is now the one that's deteriorating, and that causes the red shaded area to start to shrink. And you'll notice in the past 3 recessions, when the red shaded area starts to shrink in earnest, you're on the front edge of a recession or slightly past the front edge of a recession. We might be a data point or two away from being definitive on this, but it has certainly started to shrink in a definitive way over the past year or so. So this has us on recession watch. Here's the leading economic indicators, which have not worked at all. That's because they're so manufacturing oriented, and manufacturing got weak early on into the lockdowns after the first initial surge of 2020 and 2021 of people buying manufactured durable products. Now we see that the leading indicators for 12 months has been negative for like 2 years. And the 6 months annualized has been negative for even longer than the 12-month, and they're still negative. But this has not worked very well. One thing I want to show, let's look under the hood of the most recent report on the economic indicators. It's a little bit harrowing, quite frankly. We'll see that there are only 2 components that were up in any significant way. And those were stock prices and the leading credit index. Well, stock prices have stopped going up. The S&P 500 isn't even up since the last Fed meeting, July 31st. But everything that's really kind of important looks like it's negative. So what they call the dispersion of the leading economic indicators has gone back to a negative situation. A couple months ago, we had a month where there were 6 that were positive and 4 negative. Now the negatives far outweigh the positives in magnitude and even in number. Now the Fed has this other mandate, and they call it the labor market. And Jay Powell has been using the term that the supply demand of labor has come back into better balance. And what I think he's talking about is the bottom panel, where we see those green bars. And those green bars were so elevated because the yellow line in the top panel was, really far. The orange line on the top panel was really far above the blue line, and so labor was out of balance. Supply was less than demand, but now they've come more in line, And when he says it's back into balance, it kind of looks like it was pre-pandemic, pre-lockdown, which was a labor market which seemed to be functioning fairly well. But I'll tell you one thing, the trend here, it might be in balance, but the trend here is a little bit troubling. You can see those green bars are going down almost monotonically and have been for over 2 years. And so is this really going to be, is this trend going to continue, which would lead to even more pressure on the Fed to ease rates more aggressively? Well, let's look at some employment trends and see if that's justified, that logic that maybe we're going to go into a balance where we have more supply of labor than demand for labor. Well, here's our old friend, the unemployment rate, the U3 unemployment rate versus its 36-month moving average. And we've always said that when it crosses over, the blue line crosses over the tan line, that's strong evidence. They're at the front edge of recession. Look at the last 3 recessions. It's almost a perfect indicator. Well, guess what? We've crossed over, and you don't need a magnifying glass anymore. It's definitive. We're not only above the low of the unemployment rate by 50 basis points, we're almost above the 36-month moving average by 50 basis points, which is virtual guarantee of recession. So this trend is not favorable at all for the Fed if they want the labor market to stay at the present supply-demand relative balance. And here we've got this overlaid against the recessions going back to 1953. The blue shaded area is the middle 2 quartiles leading up to the recession. So we're taking out the tails, the top quartile and the 4th quartile. We're just taking a look at the observations in the middle. And the yellow line is the median of that blue shaded area. And we've got 2024 on here. And it sure looks to me like we're following the median of the recessions. In fact, this suggests, just this one variable, that we are already 4 months into a recession. On CNBC on July 31st, I said, my work shows that the history books will say with high confidence, I say the history books will say that in September of 2024, we were in a recession. Here's it's a matador that the government seems to be pulling. They don't want to show you things. These are the benchmark revisions. And here we are on non-farm payrolls. And we see that there's been a lot of downward revisions. If we go back for years, we've got very few upgrades compared to downgrades. So it looks like they've been over-reporting non-farm payrolls, only having to adjust them lower. And it's not just this employment report, it's also the household survey, where they've now had 6 out of 8 months of jobs, 6 out of 8 months of jobs being lost, full-time jobs in the household survey. And year to date, we are now negative on employment. We have employment shrinkage on the household survey cumulatively here through the first 7 months, coming up on 8 months of 2024. Part-time jobs have been a little bit better, but there's plenty of evidence that many people have 2 part-time jobs. So it's not like a person wants to have 2 jobs. They have 2 jobs because they need to have 2 jobs. And so if you've had 1 job and now you are driving an Uber as a second job, that's not exactly great job creation. That's people getting jobs out of economic necessity. So let's focus on full-time employment. And it looks like it's a matador. Here's some forward-looking indicators. We're just comparing the quits rate, which is the tan line, and we've got it plotted 8 months leading the Atlanta wage growth tracker. And the Atlanta wage growth tracker has been falling. It's down by about 200 basis points from the high, but the quit rates, there's a high correlation here, as you can see. The quits rate suggests that we should see further improvement in the wage growth. So that would be another variable that would put us maybe sustainably for some months below 2% on the headline CPI should oil stay at this level. That's a big caveat because a lot of this inflation news has to do with commodities and in particular oil. Here's another bad trend for the labor market. Average weekly hours worked in manufacturing, clear downtrend. The tan line had been falling anyway. Then the pandemic came, but now we're going to new local lows. And first, there's an old adage, first they cut the hours, then they cut the bodies. This has been enough of a decline that it's starting to have the look of some of the past recessionary periods. And here's the trend in initial claims. Initial claims is that blue line. We've got the moving average, just smooth out some of the noise, is that darker blue line. It has gotten a little bit better in the last couple of weekly readings, but it bottomed out a while ago. And on a trend basis, it looks like it's gently rising. I think this is an absolutely critical indicator to watch, the unemployment rate and the continuing claims that give you some insight into what the unemployment rate might be doing. The initial claims, just as a reminder, come out every Thursday. So that's it's every weekly data, so we get a high frequency look at things. But look at continuing claims. This is not really improving. It's not terrible. It's kind of going sideways. So we'll be following these indicators. And one more thing, I'm not talking much about the budget deficit today. I'm sure some of you are glad about that, but here's one chart on the budget balance, which is a deficit of 4.2%. I've got that plotted against the unemployment rate. And if this unemployment rate trends this way, we can expect, for good reasons, the deficit to get even worse. The deficit's already at 5.5% of GDP. That's pretty bad. The unemployment rate's at 4.2, but we're not in a recession, supposedly. So we'll see what happens. I mean, typically when we go into these recessions, we can see the budget deficit gets way worse. That shaded area gets way worse by multiple percentage points. So let's see what happens to the deficit. That's going to be a big problem for bond supply if this budget deficit increases. I saw one of the questions from my friend Ed. What if we have a failed auction in the Treasury market? Well, Ed, that would be bad. And a failed auction would be the signpost that we might have rising interest rates in the next recession after the initial decline in yields, which has already been happening. We've already had the 10-year yield come down from the high of 502 last October into now, less than a year later, down to about 3.65. So it's already had a rally, but will the rally continue if we have to have all this big bond supply? I don't think so. So it's critical to see what happens with the deficit. A failed auction would obviously be the opening salvo of the market realizing that perhaps the next recession will have so much bond supply that after initially falling, which is provable because it's already been happening, perhaps it will reverse and we could have the unthinkable. We could have rising longer-term interest rates in a recessionary environment due to budget fears. We shall see. I think there's a good Byron Wien type of surprise thing. I'm not saying it's a 50% chance, but I think it's more than the 10% chance that most people would give to the idea that the long end of the Treasury market yields might go up sometime when we get deeper into the recession that I think we may have entered already. Here's the CBO, which is wildly optimistic on their projections. They project lower interest rates than are likely. They project lower deficits than we're even already having. And by necessity, they predict that there'll never be any recession. But here's their prediction of federal net interest expense as a percentage of tax revenue using the present tax system. And of course, it's been going vertical, and we're going to be up to about $75 billion a month in interest payments here very shortly. We're already at about $3 billion a day of interest expense. So here we are. We see this strange little hook on the dotted line projection. That's assuming that the Trump tax cuts roll off. There would be a small revenue increase temporarily for a couple of years, but then the mathematics of the deficit and the compounding of interest take over and the trajectory continues. I suspect that if Trump wins, the tax cuts will maintain and that will make this projection even more optimistic. But even this shows that we have something like 20 to 25% of tax revenue going to interest expense. That is far too low because the assumptions are pretty much universally optimistic. Here's the Treasury market. Here we see that Treasury rates bottomed out and have definitively broken out of their trend line. We got the solid line and we got the red line is 2 standard deviations up and down. And I don't know, one way to think about this is maybe we'll go down on this rate rally. It's possible that the terminus is somewhere down there at about 3.4, 3.25 on the 30-year. That would be maybe 75 basis points of room. And maybe at that point we stall out. Maybe at that point the dynamics of the deficit and the interest expense will take over. for now, it looks like we're in a rally mode for long-term bonds. And I said at the top of the webcast, really the best performer since the past few Fed meetings, from those meeting days until today, have really been long-term treasuries. They've outperformed stocks, they've outperformed commodities, they've even outperformed gold. Speaking of gold, here's what's not working. The copper-gold ratio, which if you go back to prior to COVID, we see the copper-gold ratio worked pretty well. Directionally, they were almost in lockstep, and when it would diverge, they would come back to a convergence. And that even happened post-COVID, where for a couple, 3 years, there was a big divergence, but then it was closed and it converged again. But now we're coming on a year and a half where the copper-gold model is of no value whatsoever. And I think the reason is that now that we've turned the corner perhaps on interest rates, and we don't have secularly falling interest rates anymore, and that we have mismanagement of developed economies, and we have very strong suspicions of our institutions and our elites that run them, we're getting to the point where I think people are worried about what's happening now that the fourth turning has begun, and we need to restructure our institutions and our economic and potentially our political system. That should make people concerned about being careful not to extrapolate patterns from the past into the future, when the institutions that have been central to the past over the past, 7 decades or so, 8 decades, are going to be replaced, going to need to be replaced, because we can all see that the systems that have been in place are being rejected on many, many levels. And I'm sure I don't have to go into that in any detail. So what's better than the copper gold model now seems to be Texas Intermediate Crude, WTI, where directionally they look pretty similar. And you'll notice that WTI and the 10-year have been moving directionally kind of identically for the past 2 years. And in pretty much directionally also from COVID into the peak in WTI back in 2022. The bond yields peaked a little bit later, but I'm going to be showing WTI more frequently, as it now seems to be a variable worth noting. So let's just very quickly go through some basic, big picture things on markets. Here's the stock market. And we see that the S&P 500 had outperformed the Russell 2000 for basically 14 years, particularly 10 years after 2014, reaching a relative valuation level rivaling the pre-dot-com bust situation. And it looks to me like that's happening again. So we have what looks like a double top in the S&P outperforming the Russell 2000. It's not definitive yet. I think you need to break below. Your mind can draw kind of a trend line of that great big movement since 2021 into 2024. But we'll watch and see. I feel that based upon the sentiment in the market, the valuations in the market, the fact that this chart is double topping in the context of an AI frenzy, which feels quite a bit similar to the dot-com frenzy. I'm not saying AI won't have a long life and have many profitable companies, but it sure looks like it has the valuations today that you had for the dot-coms back in 1999, which is really not a good thing to be owning. Here's US S&P versus MCI Europe. And it is not underperforming. It's basically been performing with volatility in line, going back nearly 3 years. So if you own Europe versus the S&P 500, if you're a dollar-based investor, you have to think about whether you want to own that in dollar terms or currency terms. I would own, as a dollar-based investor, I would own foreign markets in local currency terms. I don't know if it's going to work in the next year. I don't know if it's going to work in the next year and a half. But I think it's going to work over the next decade. And so sometimes you have to just go with the longer term picture, not worry about the short term performance, because you don't want to lose sight of the forest for the trees. And here's the last one, it's emerging markets. This only goes back a couple of years, but we have stopped the underperformance of emerging markets versus the S&P. And it stopped back when the real outperformance of the Magnificent Seven hit its apogee. Although there's been some enthusiasm there again, we see that emerging markets are now in line with the S&P 500 on the MSCI. So with that, the Bills managed to eke out their win 1-0. I doubt they'll be undefeated this year, But hope everybody's enjoying the NFL, and we'll look forward to the next webcast, which is in December, as we wrap up the incredibly the fast-moving year of 2024. With that, thank you for your support, and goodbye for now.